Hello, everybody. We'll be on and ready to start the webinar in a few minutes. Thanks very much.
Yes, I would just go on our website. Yeah. And then register. It starts like in a minute. All of a sudden, I was like, oh my gosh,
Thanks, everybody, for joining us today. This is Rob Macklin. I'm here with Corey Vanderpoel at Taureau Group. It's the first time we've ever presented together, so thanks for joining us, and wanted to briefly kind of cover how to maximize value in an M&A context. We've presented individually on this from time to time, both on the legal side and the finance side, but really wanted to work on a joint presentation together and talk about how those two components work together. The agenda for today, and please note that questions are encouraged throughout this process. We're monitoring the chat channels here, and hopefully we'll be able to get to any questions that you have as we go forward. So first, we'll just kind of give you a quick overview of who we are, and then talk about the current market, where things are headed, where valuations are going, and how you might think about valuation in the sales process today. And then we'll kind of spend the bulk of our time on maximizing value in an M&A context, both before a sale, what you can do in that 1 to 5 years prior to a sale, and then how to actually during the sale process, once that sale process starts, how you can maximize value as well. Both components are critical. We're going to try to cover both of them together. So a brief introduction to both of us. Epiphany Law. We are a full-service business boutique law firm, and what that means is we're a small firm. Just about a dozen attorneys, but we do have a full suite of corporate services. Myself, I'm a specialist in corporate securities and M&A, and we have a number of other folks at the firm that do the same. But we also have a strong litigation team led by some former big law litigators out of Chicago, as well as HR capabilities and a patent and IP team as well. So although we're small, we do have a kind of full suite of products that we can offer to our clients. As a firm, we tend to be quite practical in our approach, which is one of the reasons why I wanted to ask Corey today to talk about how, together we can jointly work to maximize value. But most of our folks have either had big law firm experience, they've owned their own firms, or they've owned their own companies, excuse me, or like myself, we spent a great part of our career in-house, actually managing a P&L and really thinking through how to get the best bang for your buck out of your legal spend. So as a firm, we tend to ask, really, what does the business need? What do we don't necessarily want to provide you the answer that we want to give you, but we want to think through your business, understand how you actually make money, and provide you the best legal guidance we can after that. So I myself have done about $6 billion of M&A, a fair bit of that in-house and a fair bit of that at a law firm. But that M&A has been everything from small minority investments into startup companies up to major multi-billion-dollar transactions. I've done M&A both domestically and internationally. Spent a fair bit of time in Europe and in Asia as well. Additionally, led a bunch of securities and capital raising fund formation group for both public and private companies, and have had a lot of fun doing it over the last couple of decades.
Thanks, Rob, and thanks for inviting me to join you today. We appreciate your interest in the M&A market and continue in creating value in your business, a very important topic in today's day and age. I'm Corey Vanderpoel, Managing Director and co-owner of Taureau Group. I personally have been in investment banking for nearly 20 years. Taureau Group is a premier investment banking firm that has completed hundreds of M&A transactions worth billions of dollars of aggregate value. We have a team of 10 employees and are based in downtown Milwaukee. We serve clients all over the world, but most of our clients are located around Wisconsin, Illinois, and Minnesota territories. The other side of the transaction could be anywhere in the world, as we have a lot of international deals and component to our transactions as well. Our typical deal size is between $5 and $150 million, and we represent clients looking to sell their business, recapitalize their business, or even acquire other companies. Taureau Group also leads debt placement projects in which we identify and negotiate senior and mezzanine debt for companies. This slide just shows a small sample of some recent transactions we've conducted. You'll notice that we serve a number of different industries, but manufacturing probably exceeds 50% of our client base, the remainder being service businesses and wholesaling or distribution. We also do a lot in packaging, metal fabrication, food and beverage, medical, and plastics. Now we're going to move on to discuss the basics of valuation in the current M&A market. First, to address the most common question, what is your business worth? Obviously, a deal takes two parties. So the ultimate price is what someone is willing to pay. You can get valuations from many different providers, and they can give some great direction for planning purposes. But the quote unquote true value will only be determined at the time of an actual sale. So a few key points. Buyers will value your business differently, not only because of the various transaction avenues as shown on the slide, from liquidation to an ESOP to private equity recaps and strategic buyers, but also based on their own objectives, synergies, and risk aversion. In every deal, we take through broad marketing efforts, which are generally about 500 plus parties as potential acquirers. The highest offer is always double the lowest offer. And that's a big range when you're talking about a $50 million transaction, but shows how different buyers look at the deal differently. Secondly, price is not the only term that's important when you're considering the quote unquote value of your business. Value is a holistic term of hundreds of deal terms. For example, you might want to focus on getting a higher price and taking more contingent value, such as a seller note or earnout. Or you might take more risk on indemnification caps or purchase price allocation. The same business value of $20 million could have millions of dollars in difference to the proceeds when you look at some of these other terms. Remember, net proceeds is the best term to consider when discussing value. Valuation is based on a number of factors. Most importantly, three primary considerations, including business performance, market conditions, and the M&A process. Value is generally a multiple of EBITDA or profitability. At least we discuss it that way for communication purposes. So the higher the profit, the higher the value. Additionally, the visibility, certainty, and predictability of any cash flow streams is going to add to that value. Market conditions, a very unique topic today, going through the COVID-19 pandemic, also play into the equation, as there are more buyers in good times and some willing to push value. Maybe it's requiring lower returns on investment or having more comfort with the certainty of future cash flows. Obviously, we're in a unique time right now. So we're going to discuss this later today, but clearly this is having an impact on the M&A market and valuations. Lastly, the process through which a business is sold and the quality of the transaction team can greatly contribute to value. We prepare the appropriate materials with a compelling story and market a business to maximize interest and negotiating leverage. This negotiating leverage can add millions or even tens of millions in value, and just as important, lead to more beneficial legal terms. Every quarter, Taureau Group publishes a newsletter that you can see on the slide that shares the latest market trends and valuation statistics based on recent transactions. Per GF Data Resources, which is a source that covers private equity transactions, for the year 2019, businesses with values between $10 and $25 million realized values of 6.1 times EBITDA. Now, a big disclaimer, not every business is worth 6.1 times EBITDA. Some might be more, some might be less, but something to keep in mind, that's just an average based on historically reported transactions. Prior to COVID-19, the market was at a peak. It was driven by strong company performance, along with a strong population of acquirers, supported by substantial capital in the marketplace through bank and mezzanine debt lending, in addition to nearly $1 trillion of equity raised by private equity firms and substantial money sitting on corporate balance sheets. While this market will return in the near future, it's important to know that, it's now in the past. As COVID-19 has materially impacted the lending environment and buyers' comfort with the certainty of financials on which business valuation is based. Accordingly, these are fairly uncertain times for getting deals done. But please know they are getting done. We feel that the market will dramatically improve over the next few months in regards to strategic buyers. And we're expecting to begin marketing a few new deals in July.
Actually, Corey, if I can jump in, we have had a number of clients, I would say, in the last month or so, where you're starting to see kind of PE begin to sniff around and come back into play. And I think what's interesting to me is the size of companies that PE is going after today. So perhaps 10 years ago, a private equity firm would not have even considered a company with $2 or $3 million of EBITDA. But today, I think even if you have a company of that size, you might be getting a call from a PE firm. They may not want to hold you as a platform, but they may want to use your company to tuck into another acquisition they have. So I do think, and if I'll make a prediction here, but I think this is going to be a fairly fast recovery in the capital market side. So I don't know, in September, come back and tell me if I'm wrong. But I do think that the money is around. The money almost has to be spent. Otherwise, the PE firms will lose it. So I think, you guys marketing deals coming up soon, I think they'll get some reception.
Yeah, we're trying to time it right to where everyone's back and looking for acquisitions. We immediately, when COVID-19 became more apparent into the impact of the M&A world, we started to see private equity groups switch gears to more minority recaps, really focus on providing target companies liquidity, helping with their capital structure. And in the past few weeks, as we begin to see some opening signs in the economy with businesses, we've started to see that regress back to their traditional investment criteria. So we think it's going to continue to evolve back to where it was. and we're hopeful that we get there fairly soon, as there are a lot of M&A deals that are waiting to happen.
And actually, just we didn't actually put it in the slide deck, so I'll ask it now. But in that minority recap context, is there anything that we're going to talk about today that isn't really applicable to a minority recapitalization, i.e. selling a third of your company? Or would you say these general principles apply whether you're selling control or whether you're selling even a minority share?
Yeah, it's a great question. I would say that for the minority recap perspective, in the situations that we've been involved in as a firm, generally the most important thing is to understand what you're taking on as a partner and what their ultimate objective is, because they might provide short-term capital and equity to get you through a certain situation. They, as a partner, have that long-term perspective generally to get the other components or equity of the business. So their overall goal is still to ultimately acquire the entire business over time. So you just need to think about what has changed once you take on a minority partner with your rights, and also what is the end result that you're potentially agreeing to.
But cleaning up the business, maximize the value is still a critical component regardless of size.
Absolutely, it always applies. Yep. While COVID-19 has caused the economy to enter a recession, it's very different, and it even feels different than the Great Recession of 2008. This economy was artificially forced into shrinkage and unemployment. While some deals have been put on hold until there's more certainty to the direction of the economy, others are pushing through under similar terms. We see a lot of strategic companies moving forward with deals, or potentially private equity companies are modifying terms to make sure that they're comfortable, or modifying the timing somewhat, but still pushing through certain deals. So lenders are also seeing pretty big impacts, and that's dramatically decreasing their lending availability. So we've seen certain lending situations on our transaction where the lending availability has dropped in half. For example, if you're getting 4 times EBITDA of senior debt on a deal, and now the senior lender is only providing 2 times of EBITDA, that's a significant gap in the capital stack that then needs to be filled. And it's generally looking to be filled by equity or some other kind of non-contingent portion. Valuations are difficult during this environment because no one really understands what the financials of the company are on some of these companies that have been impacted. According to a survey done by Private Equity Info, the majority of respondents expect company valuations to decline 10 to 25%, very notably in the short term, because of COVID-19. After that, they see reliable projections coming back in about 6 to 12 months. So that means if we're seeing this data published in March, roughly September at the earliest, as when financial projections might be more certain. So that's something to keep in mind. From our experience at Taureau Group, we currently have a number of deals that are moving forward despite COVID-19. And they're doing so after a lot of efforts around the capital structure, making sure that lending is in place, and also some modifications to transaction terms when applicable. In some instances, the target businesses that we're representing are actually performing just stable and well through this pandemic. So we haven't had as much of an issue. Most importantly, there's a misperception that you as a business owner can't do anything M&A related during this time. But I completely disagree with this. Now is a great time to actually start the sale process. It takes a few months of preparation before you're even ready to go to the market. But this also gives you time to prepare and go through some of the aspects that we'll be discussing today. And also we'll get involved and help you track expenses and challenges that were impacted by COVID-19. So you actually get some assistance going through that process. So it's a good time to actually consider starting that sale process. It's also a great time to look at acquisition opportunities as we see more interest from targets who potentially need some assistance through these times. Now I'm going to turn it over to Rob to discuss some of the legal issues or impacts by COVID-19.
Absolutely, thanks. So, what's interesting about the legal component of COVID-19 is just the uncertainty around it. And so there are a number of sort of contingent or uncertain liabilities, really unquantifiable liabilities that are attached to companies these days. what makes this hard is it becomes difficult to actually put those into a financial model and decide what's there. So what that means is we're going to be there'll probably be some fair bit of negotiation around various COVID-19 liabilities. In particular, though, problematically, what you've seen, we'll get to this in a minute, the impact of reps and warranties insurance on deals being done today. They're almost, it's becoming ubiquitous. I actually remember when I was a baby lawyer back last millennium, being pitched on reps and warranty insurance, and somebody came in, and it took about 10 years before anybody actually ever used it. I talked to anybody that ever used it in a deal, and then seemingly in the last 6 or 7, 8, 10 years, it's almost on every deal, particularly the private equity side. Mm-hmm. But this is COVID-19 is going to be one of those liabilities that you won't be able to provide reps and warranties insurance around, unfortunately. So what can you do then? You can really make sure that your company appears to an acquirer as prepared as possible, right? So first of all, we want to minimize the impact of COVID-19. So you want to have a plan for certainly how you're going to do that. And what I would say is, if you remember back to the 2008, 2009 timeframe, cash is king. And so reacting quickly to your environment, providing right-sizing your business, getting your cost structure appropriately set up, but also, I don't want to say hoarding, but I'll say hoarding cash as much as you can, working with your financing sources, working with your lenders to keep that cash on your balance sheet, so that to an acquirer, you are ready to go and can survive kind of any, weather any storm, as it were.
And that's really an important topic. And a lot of bankers that I know are working with their clients to help with, say, 13-week cash flow projections and so forth. There's actually a lot of tools that you can use in your arsenal as a business operator to generate cash, whether it's managing your working capital, whether it's looking at some of the loan assistance programs out there and so forth. So it is very important as you go through this COVID-19, and hopefully we're on the tail end of it, but it is important to manage that cash. It's not only for when we're going through the heat of the COVID-19, but also as you ramp up production again. That's a very important time to manage that cash as well. So get the appropriate assistance you need, ask the appropriate questions, but definitely go through the exercise.
Yeah, now is not the time to be prepaying debt.
Right.
So we want to avoid that. But what you can really get, and Corey alluded to it earlier, get a handle on the actual financial impact of COVID-19. I spent about 6 years at a public company, managing the securities disclosure process, and 6 years of quarterly earnings calls and running through those. And my cynical takeaway is it's sort of amazing what people will let you adjust out of your earnings. If you're selling to a strategic who might be public, really tracking those COVID-19 impacts, so that the strategic can mentally adjust those out of your earnings and sort of magically increase your EBITDA somehow, because they may be doing the same when they're providing their public reports. Additionally, private equity firms will tend to, I don't want to say wave a magic wand, but they'll ignore some things in the short term because they're looking really at long-term cash flow projections. So really having a very crisp answer to what the COVID-19 impact was on your business and what it will be in the next 6 to 12 months is absolutely crucial, because if you provide a crisp answer, you can effectively change your earnings or how your earnings are perceived by an acquirer, for sure. And then lastly, I would say, if you have legal issues that have come out of COVID-19, whether they be employee-related issues or frankly issues with customers or suppliers around, let's say, non-payment, for instance, get on top of those. Don't let those linger, because there's one thing that an acquirer doesn't like, which is uncertainty. So if you can address any of those legal issues up front, or at least have a very concise and clear plan for how you're going to address them in the future, that is absolutely critical. So make sure that those liability claims are gone as much as possible, but at least if you can't get rid of them, know how you're going to get them in the future. So now, let's set aside the COVID-19 issue for the moment. Where are the legal markets going in some of these M&A deals? So what I would say is, over the last 20 years or so, 10 years especially, you have a tendency towards deals that are sort of light on reps and warranties. I think there's been a realization among acquirers, and I think probably led by PE as much as anyone else, that They're in the business of getting deals done. They're not in the business of negotiating reps and warranties or satisfying liabilities post-closing. So certainly that's one of the reasons you've seen reps and warranties insurance coming on. And if you look sort of the bottom of the slide there, right, we're looking at, deals in that $25 million up range. 2/3 of them have reps and warranty insurance in place. So overall, simpler deals, reps and warranty light compared to what might have happened 10 years ago, or certainly 20 years ago. And you're starting to see, in addition to that, locked box deals in the U.S. markets. Those really originated internationally. That's where you're kind of, we're going to ignore all these post-closing purchase price adjustments. We're going to ignore the working capital adjustments. The price is the price, and we're going to walk away, and it is what it is. Additionally, you're seeing buyers more willing to accept data room disclosure. In other words, if it's in your data room and you've told the buyer, you don't need to necessarily put it in the agreements. And if you align that with the trends in notification, where you have low liability caps, low baskets, short survival periods, whereas let's say 15 years ago, your average liability cap may have been 25 or 30% with the survival period of 3 years. Now, I just closed a deal last month, which was a 12-month 12-month survival period with a 10% cap, and a quarter of that cap was coming out for working capital adjustments. So that's common. That would have been unheard of a while ago. But again, they're sort of put this in sum. It's quicker deals. We want them done faster. We don't want to fight about this stuff post-closing. Let's just kind of get it on and get to the next deal, because frankly, this is being driven by PE, and they've got a lot more money to spend, and they don't want to take their time fighting over the last deal. They want to go on to the next deal.
Yeah, and I would welcome some of that, because simpler the better. We as advisors probably, working capital is a very simple topic, but it's very complex in the application of it and the negotiation of it. And we probably spend more time on that topic than anything else. So, the lockbox, we've seen a little bit of it, but again, mostly international so far. If that comes over here, that potentially saves a lot of time and efforts on transactions.
I did one deal for a strategic where we were buying a company in Germany, and the working capital, current assets minus current liabilities. That took me 3 flights to Frankfurt to work that out, right? And so
that sounds about right.
It's a big deal. So then as we go on, next big topic of the agenda is, what do you do to maximize the value before a sale? And a buyer is really looking, and I'll give Corey credit for this slide, really 5 main areas here. And these are a great way to put it, the five Ps. Buyer's looking at performance, your people, your position in the marketplace, your potential, and your problems. And what's interesting about this is only one of those items, your performance, really is kind of historical financial information. Everything else, really, we're looking at what is going forward and how we're going to tackle things in the future. So obviously, financial performance is going to be one of the keys. If you don't have positive EBITDA, you're not going to get a really good buyer. But what the buyers are really looking for, growth over historical periods, and a good crisp explanation as to why that's happening, why the variations are moving year to year. They want to see improving margins as well. So we not only see top line growth, but we want to see margin growth. And then the ability to look back and say, okay, when the business has had a dip, a downturn, they lost a customer, there was a recession, there was a problem, how did the business respond to that? Because that's going to give me a sense going forward as a buyer, hey, what is it going to be like if something goes awry?
You mentioned the ability to explain year-over-year variations, and I would say that that's probably one of the topics that comes up early in the process as we as investment bankers are reviewing the financial trends, and we start asking questions to our clients of what caused a certain trend in their mind. And a lot of times the story that we get from the client doesn't match the data. And we need to kind of back into that and ask more questions as to, okay, was that possibly in a different time period that you're remembering, or did it not have as much of an impact or more of an impact than you think? So it's always important, because buyers are going to analyze the data, that we, in presenting the opportunity, match the story with what the data shares. Really important as we build credibility through the process.
Next main item in that 5 Ps, the people. And for me, representing strategics for a long time, I would say this was the biggest deal killer that we had. We could look at a teaser, we could look at the company's financial projections, and when it came time to sit down at the management meeting and sit face to face with the management team, unless we were convinced the people were quality and the folks that are staying, the folks that we needed to stay were going to stay, and the folks that we needed to leave were going to leave, we wouldn't do the deal. At the end of the day, you say you buy people, not businesses, and that management team that's coming over is absolutely critical. But what I would say there is make sure that you're not just looking at your top level management team as well, but that there's a succession plan in place, because the management team that you have now in that transition may commit to stay for a year, but the folks below them, are they quality? Do you have, for instance, is your controller ready to become your next CFO? And if not, when we're thinking about maximizing value in the long term, you may want to get the right people to move into those seats to give an acquirer a real sense of comfort that this business is not just a short-term proposition, but it's going to be valuable for the next 5-10 years. Number 3 item there is the position in the marketplace and your differentiation. Now, by differentiating yourself, and it's basic business theory 101, but certainly differentiating yourself, you can drive higher margins and protect yourself from new competition entry. So taking a look at how your company, and really understand how your company is differentiated from its competitors in the marketplace. How can your company defend the position as it has, whether it's because you have a very sticky customer base for whatever reason, your customers can't move or don't want to move because the cost of moving away from you are so high, because you just have a great brand name or phenomenal marketing team that can keep that brand up, or you have perhaps intellectual property around some of your products, and it's interesting to me is I think each acquirer may have a slightly different emphasis on what is important. If you have a PE firm, for instance, led by a bunch of engineers, they may really care a lot about IP. If you have a PE firm that's staffed by a bunch of former marketing people, they may think a lot more about brand name recognition. Not that any given individual acquirer won't think about all of those things, but certainly everyone has their own biases and how those come to the table. And the more you can demonstrate sort of quality differentiation and positioning in all of those areas, the more opportunities you have with a larger number of potential acquirers.
Yeah, the intellectual property is interesting. That comes up on a lot of our deals that we're working on. We've actually done a deal previously where we got involved early on and noticed that the intellectual property was shared between 2 completely unrelated companies. And they both just historically trusted each other to use it. The client thought that there would be no issues upon a transaction. And we anticipated a few bottlenecks here, and Rob's probably laughing, but as we got deeper into the process, sure enough, when money's involved, objectives can change, and that negotiation to essentially get that 100% ownership of that intellectual property added about 2 weeks extra to the process and nearly cost the deal. So, the more preparation around that, the more likely you are to go to market with a clean business.
And it is, the IP protection, whether it be a patent, a trademark, or what have you, is critical. And frankly, it's not something that can happen quickly. And I think as Corey said, a lot of times when times are good, we're going to waive and pretend those issues don't exist. But they are quite critical. And if you've ever been involved in litigation surrounding intellectual property, you understand that it is insanely expensive, and an acquirer doesn't want to have to look at a company that has, let's say, $7 million of EBITDA. That EBITDA is being protected by a patent that exists, and to litigate that patent and protect it, it's going to be a $3 million lawsuit. I mean, it very well might be. So those sorts of things will materially impact the valuation you can get, and you want to make sure that is crisp and put away. And the best time to do that is before whoever is on the other side of the transaction knows that you're selling, and they have hold of value.
Absolutely. Moving on to number 4, potential. While buyers are interested in the stability of the base business and they value it based on that, they also value the growth opportunities and the potential for what the business could be. So if you're looking for a high valuation, you need to have a well thought out plan to realize growth. Understand the timing and costs around various growth avenues, and the more evidence you have to prove the credibility to growth, the more buyers can incorporate it into value. We often have people say, well, I want a 15 multiple for my business. That might be okay if you can prove that the growth is there to get that. Now, I should throw out the term 15, but don't take it that way. Most businesses aren't worth a 15. As I mentioned before, we have a 6 multiple based on historical transactions of $10 to $25 million businesses. If it's higher than that, generally it's going to be based on recurring revenue streams or the potential or the growth opportunities. While it's great to simply realize growth by hiring more salespeople or making acquisitions, these avenues really don't provide the certainty that a buyer would get from a more detailed growth plan. So really look into what your growth plan is. Number 5, problems. Every business has problems, and anyone that thinks their business doesn't will probably have something found by a buyer. They will come out and it's best to proactively address them for a few reasons. First, they can be positioned appropriately when they're known by advisors and can be shared. Second, you want to negotiate terms with everything on the table to reduce potential price cuts later in the process. Even big problems can really be addressed and generally overcome. It might take going to more potential acquirers or adjusting pricing or indemnification appropriately, but they can be overcome. And some examples could be around customer trends, union or pension issues, environmental challenges, or employee problems.
And I think the key there is providing yourself enough time up front. Like all of these issues, they can be fixed, right? We can think about your union contract, perhaps in the next negotiation. But as soon as you put the company up for sale, or as soon as anybody gets a sniff that it's for sale, now the other side to all of these problems has hold of value. And they can kind of rake you over the coals, and you're going to pay a lot for it. So the key here is getting on them aggressively and up front before you have to pay a lot.
So we want to go through a few just summary items of building value. So this is for financial matters in 1 to 5 years before a sale. When we're looking at maximizing value, there's certain things that we don't have control of as advisors, but you do as a business owner. And if you have 1 to 5 years before a sale, you can focus on certain trends, such as sales growth and profitability trends, both of which directly drive value. You can also consider diversification strategies, such as acquiring another business to diversify your customer base, or putting agreements in place with those top customers. Another very important consideration is to make sure that you have the right people in place, which shouldn't include you as the owner or seller, unless you're looking to stay involved. Your transition is a risk to a buyer, so we'd prefer to remove that risk from the buyer's consideration. So you don't want to delegate, or so you want to delegate to and promote others so you're less critical in the leadership of the business.
On the legal side, there are certainly a number of things to consider as well, and we'll kind of group these. We talked about some of them already. Certainly your IP portfolio is absolutely critical, but we'd also talk about your employment practices, your succession planning, your talent development, your employment policies. Those things can't happen overnight. You want to make sure your succession plan is in place, provide proper training opportunities, develop your lower level talent so that an acquirer can say, hey, that's that second layer down really can run the business. Those are always critical. Additionally, there are other things like surrounding your legal structure or your tax structure. There are just frankly some cooling off periods mandatory under tax law. So for instance, if you're looking at perhaps selling off part of your business in the future, if you were to conduct a tax-free spinoff today and do an M&A deal tomorrow, the IRS might recharacterize that transaction from a tax perspective. But if you give yourself a little bit of time in between, that's not so much of an issue. So there are certainly a number of things there to consider structurally that need to happen, frankly, just with enough time between the sale and when you do them to make it work. Additionally, litigation and regulatory issues, right? Again, you can settle those if given enough time, but if you're up against the gun or you're up against the clock, it's going to be far more costly to settle those. And then finally, this isn't necessarily maximizing the value of your company, but maximizing your own personal take-home. Take a look at your estate plan. Make sure that your estate plan actually coordinates and jives with your company's succession planning as well. Because at the end of the day, the money's going to go into your pocket. You're going to have to do something with it. Make sure you have a proper process set up to take that money into place. Question that just came in, Corey. Probably I'll kick it to you. But does it make sense to go to market before the numbers indicate some kind of stability and giving buyers comfort around the virus? When's the right time? If you're now you're in flux. How do I think about timing?
Yeah, that's a great question amid COVID-19. And what I have is really two comments. First, the timing to get something started. I think it's a great time to get something started. As I mentioned earlier, when you can spend that first few months of a process that are preparation, going through that during COVID-19, you're going to have advisors really questioning how your financials are performing, what's happening, and tracking certain EBITDA adjustments and so forth. So you get someone to do that work that you should be doing to really build the value of your business during this time and realize that impact of COVID-19. The second part or component is really when you want to go to market. And yes, when you're seeing some inconsistencies or volatility in your business and you don't have an idea of exactly when it's going to return to more normal, then I would wait until you realize that more normal run rate or volume and trends. So if that takes another month, then I would wait for that to make sure that buyers are actually seeing the certainty or the more comfort with your financials. We have a few businesses that we're working on right now where we think that they're going to have some stability to where we're marketing them in July. If you need another month or two to really foster that stability, I would wait until you have that and can then talk to buyers about your financials with credibility.
But at the end of the day, during that period of time, we as your advisors can be doing things to help build that value.
Absolutely.
So there's certainly longer term things you may want to think about in terms of years, but even between the time, if you properly engage your advisors ahead of time, you may give us 6, 9, 12 months before the sale to kind of get your house in order. And so there are a number of things that you can do to kind of put kind of the final polish on your company. If I were to put this into call it the context of selling your house, the things that you might do 2 years at a time is perhaps enclose that porch, make it a 4 seasons room, add on that extra bathroom you need, remodel the master bathroom. Those are years out, but right before you go to sale, you're still going to want to maybe get new carpet, put paint on the walls, mop the floors, and throw some cookies in the oven so the house smells nice, right? And there's analogies to that in in an M&A context. And Corey, one of the things you mentioned to me was just, hey, actually cleaning up. Like if you have a factory, like dust it and put in new lights and make it look nice, right? That's a big deal.
It's amazing when you're buying real estate, you definitely look for that when you're looking for a home. Same buyers are looking for that in a business too. When they come to visit during a management presentation, they want to see things in order. They want to see that you have good, safe conditions for your employees that are well lit and keep them happy. They want to see that the offices have been invested in, and there aren't things that are unsafe or creating issues. That same function that you put into your building and the look of it, they take as the same way you're going to look at your financials and the time and effort that you're going to put into them. So it leaves a lasting impression, and probably the horror stories that I hear from buyers that have looked at hundreds of businesses are the ones that they walk into and they're appalled at the condition of the facility.
Yeah, it's amazing. You want to look like you kind of have your stuff together. You're not on a webinar. I'd probably use a different word, but it's critical. And this is where when we think about kind of prepping for sale and what you want to do and what you want to don't. Really, these last things that you're going to do right before you go to market really kind of you're tying your company together. You're looking crisp. You're looking professional. You're putting the suit and tie on before you go off. Buyers care about that. It's the last thing they're going to think of you, and certainly that image that you present is going to be critical. So just making sure your files are organized, that you've addressed these issues that you can. You've got your silly owner perks are not in place. Those things, looking at the business with an outside perspective, and that's I think one of the reasons that you want to engage your advisors certainly early. Is you want to get a third set of eyes on the business, what it looks like, how it presents to a company. I've done on the buy side probably 50 management presentations and done factory tours, and you sort of when you have a good feeling as soon as you walk in, or you have a bad feeling as soon as you walk in, and even though the management presentation may be 4 hours long, you kind of got 10 minutes, and then you sort of know whether you're wasting your time or whether you've got a good thing. So make sure that you look at quality to folks that are going forward.
Rob, I like your comment on consider your advisors early, because that really goes to the question that was asked by the audience is, when is the right time to go to market and so forth. And I broke it into two. One is, get your advisors ready and involved. And secondly is the go to market time. But getting your advisors involved early just gives them much more awareness, much more ability and time for you to get things in a row, ducks in a row as well. So that's really a good component and good advice.
And I do think when we talk about advisors, I'll probably maybe bring this up to conclusion as well, but have advisors that have experience in M&A. We see this a lot with lawyers, probably less of a deal for investment bankers, but you may have a law firm that you've worked with that has done your legal work for 20 years and they're doing a phenomenal job. But think about and consider advisors on that M&A front that do that for a living, that know that it's different. I myself would have no idea how to handle someone's divorce or real estate closing or file a patent for them, but I got people who can do that for me. And the folks that do that for me, they would never look at me and say, hey, I'm going to do an M&A deal. So everybody has their own specialty, and when you're looking at a transaction which is providing family or generational wealth for yourself, your relatives, bring in the right team that can handle that.
Yeah, I absolutely agree 100%.
So what about during a sales process? There are a few things that we can do as well to maximize value.
Yeah, we're gonna cruise through this in the interest of time, planning for the process and actually going through an M&A process. So the first thing to note, deals aren't done on the back of a napkin anymore. They're very strategic, and every step during the 7 to 9 month process is well orchestrated and done for reasons to really maximize that negotiating leverage. There's a few things that you should know. First, be prepared for the fatigue of negotiating hundreds of terms. While your advisors are going to be leading this effort, there's a lot of uncertainty and back and forth, and that will impact you. Secondly, rely on your advisors. You learn a lot by completing hundreds of transactions. There's a skill set there. There's market knowledge there. So the more you can rely on it, the better. Most importantly, keep your eyes on the business. One of the greatest values of engaging an advisor that you trust is that it allows you to then focus on what you're good at, and that's running the business. Every month that we go through a process, the buyers are going to be asking for every historical month of financials. So they want to see that the trends are staying up and there's no drag on the business. So that's very important that you keep your eyes on the business. And lastly, focus on the big picture. There's many negotiated points, so we want to focus on those that are going to give you the most impact. On slide 28, the sale process considerations. When considering your direction regarding an M&A process, it's ideal to take into account a few different considerations. Your objectives. Do you want to maximize value? How worried are you about confidentiality? While we're worried about confidentiality and want to protect it on every single deal and have a great track record of doing so, certain owners just don't want to approach a market at all. So we want to take everything into account to make sure we realize their objectives. There's generally 3 process scopes: a negotiated deal, a targeted process, and a broad process. The negotiated deal is essentially a one-party deal. So this is going to be where you either approached a strategic party or they approached you. And while confidentiality is at a premium, the party's still likely to be in your industry, so that presents a higher risk. Also, the deal will be very customized. The process will be a bit unstructured. The most important downfall of this process is that you have no comparative offers. So it's unclear whether your value and terms are good or bad compared to how someone else might look at it. The targeted process is an auction process with formalized materials, which is focused on a smaller population of buyers compared to the broad process. So we've done this a number of times for clients who have gotten an unsolicited offer, and we said, we feel it's a little bit low. Let's just test the market to 10 to 15 very strategic parties. And generally, we've found higher values this way, and we have greater negotiating leverage because those parties know that they're in a competitive process.
And you could probably get that first party to bring their offer up if they have competition.
Yeah, absolutely, absolutely. And finally, the broad process is generally the best way to maximize negotiating leverage and value. It's generally very formal, very structured, going to 500 plus parties. Sometimes we'll have 30 plus indications of interest from that process, which obviously gives us the options and the negotiating leverage to maximize value. Finally, in regards to the process, the funnel shown on this page is a good depiction of a broad marketing process. When starting with a heavily researched and qualified list of 125 to 1,000 targets, which is generally, just for your information, narrowed down from 5,000 to 10,000 companies researched, we seek to have about 25 to 125 signed NDAs and confidential information memorandums distributed. We'll then, based on indications of interest, invite 6 to 12 parties for site visits and expect 3 to 8 letters of intent prior to choosing a party and closing with them. Now, we do this in a confidential manner. So that's what the amazing thing is that we can do this, go out to so many parties and do it without the market knowing. Most of the time going through this process, the ultimate buyer is someone our client wasn't even aware of prior to the process. And that's what we're searching for. We're searching for that needle in the haystack buyer that is the best of the best. And lastly, before turning it back over to Rob to wrap things up, I just wanted to share again that value doesn't necessarily or only equal price. When assessing offers, value is a derivative of the transaction and capital structure, and the comfort with the buyer, and the legal terms to limit post-transaction liability, among many, many others. So all of those things really equal value.
I think that's critical, especially if you're a closely held business, a family company. You've got to give yourself permission to say it's okay not to take the absolute highest dollar value because I care about my family name, my legacy, the talent that my factory is in. That's fine. And I think sometimes you'll see people get maybe caught up in a process and almost against their better judgment will take that extra $3 million of purchase price versus those kind of values they want to portray. And I would say just caution you to step back, like think through it, talk through it with your closest family members, your spouse, your minister, your pastor, whatever it's going to be, the people in your social circle that know that, and give yourself permission to say what is really important to me. What do I really want? Is it maximizing the dollar value, or is it making sure that the factory never leaves the town that I'm in, or my name is always on it, or my name comes off it right away? Who knows, right?
Yeah, right. That's absolutely true. And make sure when you understand what those personal objectives really are, make sure that you're very honest with your advisors about what they are, because we're pushing for those objectives throughout the entire process, from the legal side and attorneys, from an investment banking side. We want to get what's important to our clients.
And it's okay. And a buyer, a sophisticated buyer, will take those into account and they'll work those into the deal. Now maybe what you're requesting is gonna hurt your value, and that's okay. Maybe it won't, but being upfront and communicate with your advisors is critical there. So all of that said, kind of to wrap everything up, four takeaways here and a fifth that hopefully you'll pick up from this. You certainly want to take advantage of the market. Most companies receive an unsolicited offer, every 5 years or so. So you want to take advantage of the market when the market's good, but also make sure that you know your own timing. You're honest with yourself. But what I would say is be ready if something comes along. Because if you were sitting in 2007 saying, I just want to work for a couple more years, then I'll sell, you might not be selling until 2017. So there's always some difficulty there. So be ready to take advantage of it when the opportunity does come along, which is why I think that hits point number 2, which is you always want to be thinking about building value in your business, building value in business holistically for the long term. Even if you're not wanting to sell in the next 5 years, kind of thinking through, hey, how is my business going to look to potentially acquire, understanding that exit plan up front, understanding your succession plan does benefit you. So when opportunity does come along, you're ready to go. And then once you decide, hey, maybe it's time to exit, begin that process early. Even if you're not even sure that you're ready to exit, you're thinking about exiting, go talk to some people who can say, yeah, maybe you're 18 months away, or you're 6 months away, or we can sell you tomorrow. Go talk to those folks when you're starting to think about those ideas. And you want to make sure that when you're talking, the people you're talking to there are good advisors that are specifically done M&A, that understand that process, that understand that game. Because at the end of the day, it is a specialized skill set. You want to talk to the right folks. And then lastly, really spend some time with your investment bank on the sale process. Are you going to market to one party, a limited set, or kind of go out and talk to the world? Each of those is going to drive a different process, different timing, different valuations, and really being honest with yourself and understanding what's important is absolutely critical. So with that, that brings our prepared remarks to the end. I didn't see any additional questions come in, but Corey, thanks for joining us. Any last words of wisdom?
No, thanks very much, Rob, for putting this together, and I hope it was helpful to the audience. I think the two things that I would comment is one, preparation is very key. You can change the value of your business by focusing on certain things with enough time. Plan early. Secondly, regarding COVID-19, we are starting to see things open up again. It's been really the only thing that people have been talking about for the past few months, rightfully so, as it's had a huge impact in the entire world. But we are starting to look beyond that and look to where the M&A market goes. And I think it's a good time to start that process of considering what your personal objectives are, because the market will return, lending will return, private equity is sitting out there with a lot of money, strategics are looking for those same growth avenues. So don't rule out M&A, it's here to stay.
Fantastic. And with that, we'll end the presentation. Thanks very much. We'll shoot around a follow-up email for folks that need copies of the slides or recording the presentation. Thank you.
Thank you.